The war with Iran.
As Iran is being attacked.
America's strike on Iran.
On February 28, 2026, the world changed. U.S. and Israeli forces launched strikes on Iran, and within 72 hours, oil jumped 8%. The Dow dropped 700 points. 4,000 flights were canceled every single day. And the world's most important waterway, a choke point that controls 20% of the planet's oil, essentially stopped moving. But here's what nobody's talking about. While most of the world is losing money right now, a very specific group of people and companies are making an absolute fortune. Today, we're going to break down exactly who's getting destroyed and who's quietly winning. In the most chaotic oil market event since the Gulf War, stay with me, because by the end of this video, you'll understand the global economy in a way that most people, including most investors, simply don't. Section 1. What actually happened? The $12 oil shock. Let's set the scene quickly, because context matters here. For months leading up to February 28th, the U.S. had been building up one of the largest military deployments in the Middle East since the 2003 Iraq War. 2 full aircraft carrier strike groups, destroyers, submarines, all pointing at one country, Iran. The trigger wasn't just the nuclear program. It was a combination of Iran's violent crackdown on its own protesters, with death tolls estimated between 7,000 and 43,000 civilians, and stalled nuclear negotiations that collapsed after a third round of talks in Geneva. Then, the strikes happened, and the oil market reacted immediately. Brent crude, the global benchmark, jumped from $72.48 the Friday before the strikes to over $84 by March 3rd. That's an 8% surge in under a week. WTI crude, the U.S. benchmark, went from $67.02 to nearly $78. Now, 8% doesn't sound apocalyptic. But here's the key number you need to understand. Analysts are now warning that if the Strait of Hormuz, the narrow waterway connecting the Persian Gulf to the rest of the world, remains disrupted, prices could hit $100 to $120 per barrel. So why does the Strait of Hormuz matter so much? Let's talk about that. Section 2. The Strait of Hormuz. The world's most dangerous bottleneck. Imagine you live in a city where every single grocery store gets its food delivered through one road. One road. Now imagine that road gets shut down. That's the Strait of Hormuz. This narrow stretch of water, just 21 miles wide at its narrowest point, carries roughly 20% of the world's entire oil supply every single day, about 17 to 18 million barrels. Iran has threatened to close it before, but this time is different. Following the strikes, shipping traffic through the strait dropped by over 80%. Let me repeat that, 80%. The world's biggest container shipping companies, Maersk, MSC, Hapag-Lloyd, CMA CGM, have completely suspended all transits. They're now rerouting ships all the way around the southern tip of Africa, the Cape of Good Hope, adding 10 to 14 days to every voyage. And they're charging customers for it. Hapag-Lloyd and CMA CGM slapped on emergency conflict surcharges of up to $4,000 per container. Meanwhile, Qatar, one of the world's biggest LNG exporters, had to close its LNG facilities entirely. European gas prices surged 45 to 50%, almost overnight. And Saudi Arabia's Ras Tanura refinery, the kingdom's largest, was temporarily shut down after being struck by drone debris on March 2nd. This isn't a regional problem anymore. This is a global supply chain crisis. So let's get to the real question. Who's bleeding and who's cashing in? Section 3. Who's getting destroyed? Let's start with the losers. Loser number 1, airlines. The airspace over Iran, Israel, Iraq, Qatar, Bahrain, and Kuwait has been effectively closed. The result? Over 4,000 flights canceled. Every single day. Emirates, Qatar Airways, and Etihad, 3 of the world's biggest carriers, all based in the Middle East, suspended most of their operations. Their hubs in Dubai, Doha, and Abu Dhabi went nearly dark. United Airlines, Air Canada, American Airlines, Lufthansa, Air India, Singapore Airlines, all either suspended or significantly rerouted services. And here's the double hit. Airlines aren't just losing revenue from canceled routes. The ones still flying are paying dramatically more for fuel because jet fuel is priced off crude oil. Longer routes around the Middle East mean more fuel burned per flight. Ryanair specifically warned that rising fuel prices would hurt its full-year earnings. Analysts at Tourism Economics estimate the conflict could wipe out between $34 billion and $56 billion in regional visitor spending this year alone. Loser number 2, global shipping and retail. If you order something manufactured in Asia and shipped to Europe or the US, and it typically passes through the Suez Canal or the Persian Gulf, that supply chain just got hit hard. FedEx suspended services in Bahrain, Kuwait, Iraq, Qatar, and the UAE. The Cape of Good Hope reroute adds nearly 2 weeks to shipping times. That means delayed inventory, empty shelves in some sectors, and higher costs passed directly to consumers. For retailers already managing thin margins, this is brutal. Loser number 3, European energy consumers and manufacturers. Europe imports heavily from the Middle East, particularly LNG from Qatar. With Qatari facilities shuttered, European gas prices exploded. The EU convened emergency meetings on March 2nd, 3rd, and 4th. They formed a crisis task force. Energy Commissioner Dan Jurgensen flew to Azerbaijan to beg for more gas through the Southern Gas Corridor. Germany reactivated its National Gas Task Force. Greece held an emergency resilience meeting. For European manufacturers in chemicals, metals, and heavy industry, their energy costs just spiked, threatening margins, and potentially triggering layoffs and production cuts. Loser number 4, the broader stock market. The Dow Jones fell over 700 points on March 3rd, alone. Airline stocks, cruise lines like Carnival, logistics companies, all dropped sharply. When oil goes up, the cost of doing almost everything goes up, and markets priced that in fast. Section 4. Who's winning now? Here's where it gets interesting. Winner number 1, U.S. defense contractors. On Monday, March 2nd, the first trading day after the strikes, defense stocks went parabolic. Lockheed Martin gained up to 6.5%, hitting a record high. Northrop Grumman surged up to 6%. RTX Corporation, maker of the Patriot missile system, jumped up to 6.5%. AeroVironment, which makes Switchblade loitering drones, soared as much as 18% after landing a major new Pentagon contract. BAE Systems climbed over 8% in European trading, and iShares ETF tracking the entire aerospace and defense sector hit an all-time record high. Why? Because every missile fired has to be replaced. Every interceptor used needs restocking. U.S. defense spending is already projected to hit $1 trillion in 2026, and analysts are now talking about pushing 2027 outlays toward $1.5 trillion for defense contractors. War isn't a risk, it's a revenue event. Winner number 2, U.S. oil producers. For the past 2 years, U.S. oil companies had been in a tough spot. Prices were depressed. EV adoption was eating into long-term demand forecasts. 2026 was shaping up to be a gloomy year for big oil. Then February 28th happened. Shares of ExxonMobil and Chevron hit record all-time highs on March 3rd. Investors piled in, betting that their massive Permian Basin operations, which account for roughly 50% of all U.S. crude output, would fill the global supply gap left by the Middle East chaos. The American Petroleum Institute positioned U.S. producers as a, quote, stabilizing force for global energy, which is Wall Street code for, we're about to make a lot of money. Analysts who'd previously projected weak profits for oil majors in 2026 are now talking about windfall profits, the kind of numbers last seen during the 2022 post-Ukraine energy crisis. Winner number 3, Russia. This one's subtle but important. With Middle Eastern oil in chaos, countries that previously relied on Gulf supply are now scrambling for alternatives. India, which gets 40 to 50% of its oil through the Strait of Hormuz, immediately started scouting alternatives. And Russia stepped up, claiming India has shown renewed interest in increasing Russian crude imports. Russia, already selling discounted oil to Asia after Western sanctions, just got a massive geopolitical tailwind. Its oil is suddenly more attractive, more needed, and its leverage over energy-hungry countries just increased significantly. Winner number 4, China. Strategically, China is playing a long game here. It continues to buy nearly 90% of Iran's total oil exports, paying in Chinese yuan through shadow fleet tankers that bypass Western sanctions entirely. Before the strikes, Iran actually accelerated its loading pace to 3.66 million barrels per day, more than double its usual rate, in anticipation of the conflict. China also has pipeline access to Russian and Central Asian oil that doesn't go anywhere near the Strait of Hormuz. So while every other major economy scrambles, China has options. And geopolitically, the chaos weakens U.S. credibility in the region and creates openings for Beijing to position itself as the stabilizing force. Section 5, the big picture. What happens next? Here's the uncomfortable truth. Nobody knows how long this lasts. If the Strait of Hormuz reopens quickly, oil stabilizes around $80 to $85 and life goes on. Damaged, but manageable. But if it stays closed, we're looking at $100 to $120 crude. That means gasoline prices at the pump spike significantly. Inflation, which central banks had been fighting for years, could reignite. Interest rate cuts that markets were expecting, gone. Central banks may actually have to raise rates again to fight energy-driven inflation. And global recession risk climbs sharply. OPEC Plus tried to stabilize things by announcing a production increase of 206,000 barrels per day at an emergency meeting on March 1st. But analysts from Rystad Energy and UBS are skeptical. Most OPEC Plus members are already pumping near capacity. Only Saudi Arabia and the UAE have meaningful room to increase output. The Trump administration is even reportedly working with Venezuela to ship 30 to 50 million barrels of oil to the U.S. to cap domestic gas prices. A remarkable move, given the political history there. The Strategic Petroleum Reserve holds 415 million barrels. A release is being considered. But let's be honest, that's a band-aid, not a solution. So what's the takeaway for regular people watching this? If you're an investor, defense and domestic energy are the clear short-term plays. Airlines, logistics, and European manufacturers are facing serious headwinds. Inflation risk is back on the table, and that affects your bond holdings and your cash. If you run a business, your supply chain just got more expensive and less reliable. Fuel surcharges, shipping delays, energy costs are going up. Plan for it now, not later. If you're just a consumer, gas prices are going up. Goods prices are going up. The era of cheap everything that we'd started to get back after the 2022 inflation wave. That era might be over again, at least temporarily. The Iran crisis isn't just a foreign policy story. It's a your wallet story. And the businesses and investors who understood that in the first 72 hours after the strikes, they're already positioned. The question is, are you? If you found this valuable, subscribe, because this situation is evolving fast and we'll be covering every major development as it happens. Drop a comment below. Do you think the Strait of Hormuz reopens within 30 days? Or are we in for a prolonged energy crisis? I want to know what you think. See you in the next one.